Yes, friends, welcome back. So we got disconnected at that time. We are in fact discussing the concept of income. So we have already visited the Income Tax Department's website and we have seen the definition of income, which is provided under Section 2, Clause 24 of Income Tax Act 1961. And we have also seen that the definition of income is an inclusive definition. And these are the items: property gains, dividends, voluntary contribution received by any charitable, religious, trust, fund, university, educational institution, hospital. All these are income. See, so many items we have seen, right? Then these are the some points we're discussing. Yeah, after this we had discussed, I think, any sum of money received or receivable without consideration or for inadequate consideration. We are in fact discussing the point number 22. Can you read this point number 22 again?
Yes, sir.
Yeah, please.
Any compensation or other payment due to or received by any person in connection with termination of his employment or the modification of the terms and conditions relating thereto.
Yes. So if a person's employment is getting terminated or the terms of employment is getting modified, and in that connection, he is receiving some compensation from employer, that compensation will also be treated as income. Okay. All those type of compensation are income. For example, if a person is losing job, his job is terminated for whatever reason, he is given a lump sum amount, or his terms are modified. If you are supposed to be posted in one place, he's transferred to a different place, or he was heading one state, now he has to head multiple states. So these are some modification in the terms of employment. And because of this thing, if some compensation is paid, that compensation is an income. Point number 23. Please read it out.
Yes, sir. Assistance in the form of a subsidy or grant or cash incentive or duty drawback or waiver or concession or reimbursement by whatever name called by the central government or a state government or any authority or body or agency in cash or kind.
So this type of assistance, so sometimes subsidy, grant, cash incentives, these type of assistance are provided by government or from some other authorities, maybe from central government, sometimes by state government, or by any specific authority. They provide this kind of assistance in the form of subsidy, grant, cash incentive, or duty drawback. That means if some duty is paid, like customs duty, etc., that can be withdrawn, duty drawback, or waiver or concession. If something has been paid in the form of duty or taxes, that may be waived, or concessional treatment may be given, or reimbursement, certain expenditure may be reimbursed. So all these type of assistance are also income. This assistance may be in the form of cash or maybe in the form of kind also. It's not necessary that income has to be in the form of cash. It may be in kind also. Right? So all these type of assistance are income. Did you understand?
Yes, sir.
Now, friends, you see so many items we've seen. We have also looked at the definitions provided in the Act. Now, we can conclude that one thing, that the definition of income which is provided is very wide. It includes almost everything. After all, it is an inclusive definition. In case of inclusive definition, we have to understand one thing, that nomenclature doesn't matter. Okay, so suppose you will say it is not a compensation, it is something else, but law says it is compensation. It doesn't matter because it is inclusive definition. By changing nomenclature, you cannot do tax plan. Okay, are you getting? You cannot save tax by changing the nomenclature. Suppose you are giving a compensation for termination of employment. You will say, no, I will not call it as a compensation. I will call it as a reward for termination of employment. So you will say your terms, your section says compensation, so it is out of, it is not an income. No, this kind of like planning is not possible. Reason, it is an inclusive definition. Okay, understood the point?
Yes, sir.
Now, friends, few more concepts we have to appreciate. First of all receipts are not income. There is a difference between receipt and income. For example, suppose you have taken a loan, you might have received much of money. Is it income? Answer is no, it's not an income. Okay, all receipts are not. How to know what is income and what is not income? It can be compared with a tree and fruit. Why we need to compare like this? We need to understand the difference between capital receipt and revenue receipt. Okay, you see, practically you see, tree is the source. It is a source of income, you can say. Is it not? And what is a fruit? Fruit is the income itself. So receipts arising from sale of source itself is generally a capital receipt and not an income. But the income which is flowing from the source, which is comparable with the fruit, is an income because it is a revenue receipt. Okay. That means just give me a moment, please. Well, I was trying to explain you how to distinguish between revenue receipt and a capital receipt. I told you one thing, you can compare it with the tree and fruit. Source of income is the tree. For example, let us say you are earning profit from the business. That profit is the source, that is the profit is the fruit, or that is the income. But let us say you are selling your business itself. The money you are getting, that is a capital receipt. Normally, that should not be an income. So capital receipts are normally not an income except when they're specifically included in the act. Whereas revenue incomes are normally an income unless they're specifically exempt by the act. Act exempts some revenue receipts. In that case, that is not an income. And act includes some capital receipt. In that case, that is an income. Are you getting it? Let me repeat it. Give an example. Suppose you are earning salary. Salary is the fruit. Okay. But let us say your job is terminated. That means source is not there. So, and you are getting compensation. If that is so, that is a capital receipt. Capital receipts are taxable when it is specifically included in the act. If it is not specifically included, then you can simply say it's a capital receipt, it's not an income. But there are certain capital receipts which are specifically included. In those cases, it will be taxable.
Yes, sir. Got it.
Got it? You can compare it again with fruit and tree, something like this. Suppose you are getting rent from a house. That is your income. But you sold the house, that is normally a capital receipt. If that capital receipt is specifically included in the law to be taxed, then it will be taxed. Otherwise, not. Now,
Yes,
if you are thinking how to distinguish whether it is a revenue receipt or capital receipt, you have to compare it whether it is generated or whether income is comparable with a fruit or it is comparable with a tree. Okay, are you getting my point?
Yes, sir.
Okay. Now, if you read here, receipts arising from sale of the source itself is a capital receipt and not an income. But income flowing from the source is income. It is a revenue receipt. Okay, this is the, you can see, these are two general things. But the Income Tax Act has widened the scope by expressly including certain receipts within the meaning of income. That means even if it is a capital receipt, it's included. Okay. For example, certain capital assets, winning from lotteries, gives more than 50,000, etc. All these are capital assets, but law has included them. And again, you have to understand that receipt means only net receipts are taxed, not gross receipts. That means if you have spent some money or you have incurred some expenditure to earn that income, that needs to be deducted. Only net receipts after deducting the all related expenses incurred in connection with that receipt will be taxable. So what is taxable is your net receipt. Are you getting my point?
Yes, sir.
Okay.
Yes, sir.
Now, to understand this concept of income, certain principles you have to keep in mind. Quickly, let us see one by one this concept. There is a long list of concepts which you have to see, we have to discuss in fact. To the extent possible, we'll cover it today. First of all, one thing is that income includes negative income. That means loss is also an. That means, let us say you got two businesses. In one business, there is a profit of 20,000 rupees. Another business, there is a loss of 5,000 rupees. Both the things can be merged. You can say the net profit is 15,000 rupees. Okay, negative income is also income. Are you getting my point? If you say negative income is not an income, then in case there is a loss, that should not be merged with your positive income. Are you getting my point?
Yes, sir.
Okay, so negative income is also an income. Point 2. Second point is a regularity. Normally, when we talk about the income, we expect it is a kind of a periodical monetary return. Normally, it comes periodically, that means with regular increments. But there are exceptions to it. Well, that is a normal provision or normal understanding that income should have some kind of periodicity. But there are exceptions to it. There are some incomes which there may not be any regularity, but still that will be regarded as income. Third point we need to understand that the form of income need not be always in cash. Income may come in the form of cash, or income may come in the form of kind also. Income may come in kind.
Yes, sir.
Right? Next point is that income need not be received. It may accrue. Receipts are your income, accruals are also. Let us say you have kept money in fixed deposit for 5 years. After 5 years, you will receive your money back, isn't it? Along with interest.
Yes, sir.
But every year, interest is accruing. So that is your income. Even if you have not received, it has accrued. So income includes accruals.
Yes.
Okay. Got it? Now, there is under income tax law, there is no difference between legal income or illegal income. All are taxed. So tinted income, illegal income, so income generated through wagering, contracts, bootlegging, embezzlement, even theft, all these kinds of incomes are income which is taxable. Okay. Right? So there is no distinction between legal income and illegal income. There might be penal consequences under some other law. That's a different story. But under income tax law, that is income and it is taxable. Are you getting this point?
Yes, sir.
Next concept is about application versus diversion of income. Friends, applications are uh, income. They are in fact taxable. Diversions are tax free. So we need to understand this concept. What is this application? What is diversion? Try to appreciate this thing. Application means someone has earned some income, either applied it or invested it for some purpose. Okay, suppose I am earning myself or I am earning my consultancy. I may invest it somewhere or I may apply it in anything. That is application. Diversion means I have received that one, but I'm receiving it on behalf of somebody else. I have to divert it. So if that is a diversion, that the amount which is to be diverted, which is already diverted, that is not an income. I think I have to explain it with the help of some example only, then only you will be able to appreciate the point. Let us say, there is one Mr. A. Okay. Let us say A had transferred some property to B. Okay. And after that, A passed away. Are you getting my example?
Yes, sir.
And B has got that property without any consideration. Let's say they give, and B is earning some rent. Now B thought, okay, because of A, I am receiving this much of rent. So B voluntarily transfers 50% of the rent to Mrs. A. Mrs. A, who was the widow, so B voluntarily transfers 50% of the rent. Okay, because of her husband, he has received this property and he is having rent, he is transferring this. So this is an example of application. B has decided and voluntarily applied that income. Okay, so the entire rent which is received, or the entire money which is received by B, let us say B is receiving 1 lakh rupees. 1,50,000 rupees is transferred. The entire 1 lakh is B's income. He is transferring, that's a difference. That is his application. But let us think of this situation in a different way. Let us say A has transferred to B, but with a condition. It's a conditional transfer. What is that condition? That every year, whatever is the rent received, 50% will be transferred to Mrs. A. Now A is receiving B, but there is a condition attached. Out of, as per this condition, the 50% income has to be transferred to Mrs. A, and A is doing so. If that is so, even if B has received the money, there is a overriding title. Is it not? He has to divert that money. He is receiving the 50% of money on behalf of Mrs. A. He is receiving and he has to transfer. That is called as a diversion. Understood?
Yes,
if it is diversion, then only 50%, that is only 50,000 rupees will be taxed. But in application, entire 1 lakh rupees will be taxed.
Yes, sir. Got
Are you
it.
getting this point? Okay.
Yes, sir. Yes, sir.
So that is the concept that we are learning here. That applications are taxable because applications are your own decisions. Out of the income, you are transferring that thing. But a diversification, that is, somebody has got a title on it, overriding title. The diversions are not taxable. Next point here is that disputed incomes are chargeable to income tax also. Just because there's a dispute with income tax department will not.
Excuse me, sir.
Yes, please.
Sir, Orashish got disconnected. He's waiting in the waiting room. Can you please allow?
Okay, I'll do that.
Thank you, sir.
Yeah. Now, friends, what we're talking about disputed incomes. Just because income is disputed, that doesn't mean that it is not an income, right? Disputed incomes are also chargeable to tax. Are you getting?
Yes, sir.
Next point. Contingent income. Contingent income is income which is dependent upon certain contingencies. So contingent income will not be treated as an income unless that contingency has happened. When the contingency happens, that is an income. For example, there is a condition. Let us say if you'll be selling 100 units of product, you'll be eligible for a commission. When 100 units are sold, then the contingency has happened. At that moment, that is an income. But if the contingency has not happened, you have sold only 50 units. That doesn't mean that 50% income will be recognized. No, contingency has not happened. So contingent incomes will become income only when the contingency has happened. Okay.
Yes, sir. Yes, sir.
Next point. Basis of income. Next is, as you know, there are 5 heads of income. Salaries, income from house property, profit and gains of business and profession, income from other sources. Right, capital gains like this. 5 heads are there. For these 2 heads, profit and gains of business, profession, and income from other sources. How income will be computed? It depends upon the method of accounting. On that basis, income will be computed. In all other cases, what happens? The law has specifically mentioned that how, our law has specifically suggested that how income will be computed. For example, under the head salary, what are the things which are taxable? Let us say basic salary, allowances, perquisites, how it is to be computed. Law has specifically suggested that. Similarly, under the head income from house property, here also the annual value of the house property, how that will be computed, it is specifically mentioned in the law. Right. Same also under the head capital gains. But these 2 heads, profit and gains of business and profession and income from other sources, it depends on the method of accounting, how you are computing your income. One may follow receipt method, one may follow accrual method. It depends the kind of method one is following.
Yes, sir.
Okay. And yeah, now next concept is system. Then if there is some relief or reimbursement, let's say some expenditures are reimbursed, that is not an income. And there is no difference between permanent income and temporary income. Both are taxable. Gift we have already discussed. If it is received more than 50,000 rupees during financial year, is fully taxable. And some of you raised the question. I had told you that gifts from relatives, friends on the occasion of marriage are also not taxable. They are exempt. Transfer by way of will, that is also exempt. So all these things we'll be discussing in appropriate time. Next concept is composite income. One may have income under different heads under different sources. Tax system imposed on aggregate of all incomes. For example, your salary income, business income, house property income, capital gain, income from other sources, all needs to be aggregated, and on that tax is to be imposed. Next point is about the PIN money. PIN money is the money which the husband gives to his wife to meet petty expenses. PIN money, that means money earned by the wife, is not income. That's not an income. But if the PIN money is used for acquiring a property, then that is a capital asset for that lady, and income generated from the property is taxable. Okay, for example, let's say husband gives PIN money to wife and wife invests in share market. Wife's earn income. The shares are the capital asset of the wife, and the money which is earned out of that is the income of the wife. But transfer of money from husband by husband to wife as PIN money is not wife's income. Is it clear?
Yes, sir. Sir, I have a doubt.
Yes, please.
Sir, suppose there is a divorce, and as per court's order, the husband has to pay, say for example, 25,000 per month to the wife to meet her expenses as a maintenance. So in that case, that money is taxable or not?
That compensation is not taxable.
Okay, sir. So it is also compensation like company gives if there is superannuation or if there is retrenchment, company gives to employee. In that case, it is taxable. So why not in this?
No. In that case, there are certain exemptions. We'll be learning it when we'll be learning the salary chapter. Retrenchment compensation subject to certain conditions, they are exempted.
Okay, sir.
Okay. All right. Now, lump sum receipts. If it is an income, that means the nature of the receipt is an income. It doesn't matter whether it is received in lump sum or in installment, that is taxable. It's an income. For example, some people commute their pensions, entire pensions they commute it and receive it in a lump sum. In that case, it is an income because the nature of receipt is a pension. And some people receive their pensions in installments. Whether it is income is received in the form in lump sum or in installment, doesn't matter. It is an income. One more important concept is that income must come from outside. That means one cannot generate income from himself. For example, let us say you are a group of students. You collected some money and started a picnic for the purpose of picnic, and you spent some money and there is a surplus. Question is that surplus is an income in the hands of that body of individual or association of persons? Answer is no. For example, let us say you may form a tea club in your class. So money will be collected, money will be spent for tea, and there will be some balance. The balance money and the surplus is not an income because no outsider is involved here. You are only dealing with yourself. Therefore, surplus of a club, mutual associations are not income. Okay, if outsiders are coming, outsiders are joining, and some income is generated, some surplus is there, then that is an income.
Yes, sir.
Do you understand this concept?
Yes, sir.
Yes. Now, voluntary payments. These are the payments by way of donation to friend, relations, maybe sometimes to stranger, company, club, for charity or benevolence. They are not income in the hands of recipient. Even if this income is made periodically, this type of voluntary payments are not income. Next, receipt by pure chance. Normally, it is not an income, but when it is included specifically in the finance act, in the act itself, for example, lottery income, so then it is an income. Then compensation for death, accidents are not income. Receipt from life insurance policies are not income. Then charity levies, sometimes a small charges are collected from the customers for some specific purposes, for the charitable purposes. So these charity levies are not income. Okay, and few more principles. Embezzlement of cash, that is income in the hands of embezzler. Awards, rewards given by central government, state government, approved authority in public interest, their income. But some of these awards are exempted under section 17A. So award receipt which are given by central government, state government, and approved authorities in public interest are exempted. But their income, but they're exempt. Similarly, scholarships to meet cost of education or scholarship incidental to education are exempt. Then tax-free income. There's nothing called as the tax-free. If someone is saying he's earning tax-free income, that means his income tax is borne by somebody else. So in that case, your actual income needs to be grossed up to compute his total income and to find out what is his tax liability. For example, let us say your income is 5 lakh rupees, or let us say your income is 10 lakh rupees. On that, assume something. That is, let us say tax is X amount and tax is already paid. So it will be taken that your income is actually 10 lakh rupees plus X. And your tax liability will be on the entire 10 lakh rupees plus X. That is your total income. Tax which is borne by somebody else is also your income. Are you getting? So there is nothing called as just tax free.
Yes, sir.
Okay. There might be certain incomes which are exempted to tax. That's different thing. Got an idea? These concepts of income tax, all these concepts which you have discussed.
Yes, sir.
Yes, friends.
Yes, sir.
Now, friends, after that, you already know that income tax to be paid on the total income, for which you have to calculate, first of all, gross total income. It includes these 5 heads: salaries from section 15 to 17, income from house property, section 22 to 27 will be learning, profit and gains of business and profession, section 28 to 44D will be learning, capital gains, section 45 to 55A, income from other sources, section 56 to 59. All these things will be learning. We'll be computing income under these different heads. Then this will be aggregated. Then, if required, the clubbing provisions, that in some other person's income, if it has to be clubbed, that will also be clubbed. And if there is some loss which needs to be set up, which has been carried forward and needs to be set up, that adjustment has to be made. Okay, this I had told you earlier. Have you remembered?
Yes, sir.
Gross total income.
Yes, sir.
Gross total income will be computed like this. There from chapter 6A deductions will be made. We will be getting total income. That total income will be rounded off of what? To nearest to rupees 10. And that total income will be chargeable to tax. Okay, friends, we have understood the concept of income.
Yes.
We have understood there might be 5 heads of income. Income may be generated from various sources, and total income will be chargeable to tax. Section 4 of the Income Tax Act 1961 talks about chargeability. Income of the previous year is charged to tax in the relevant assessment year. And for calculating tax, rates are prescribed in the Finance Act, or there are some specific rates which are there in the Income Tax Act itself. But however, sometimes, tax needs to be deducted at source. That is called a TDS. That concept also we know. And sometimes tax needs to be paid in advance. That means the previous year itself tax is to be paid. That concept also we have understood. Next session, we'll be learning the concept of capital receipt and revenue receipt in the context of income tax. Then we'll be seeing how income is to be computed, computation steps will be done. After this, friends, is it clear to you?
Yes, sir.
Okay, so we'll close our session here today. We'll catch up in our next session with a new concept. Okay, friends?
Yes, sir.
Yes,
Thank
sir.
you.
Thank you very much. Thanks a lot.
Thank you, sir.